You know the price of a cup of coffee. You can probably guess the price of a gallon of gas or a decent used car. We understand how supply and demand put price tags on physical goods. But what is the price of a $100 bill? Money is a product. If you want money that you don't already have, you have to rent it. That rental fee is called the interest rate. There is an exclusive committee that dictates this universal rental fee for everyone. It's called the central bank. A central bank is a national institution that manages a country's currency and money supply. By turning the dial on that single interest rate, this institution controls the financial conditions for the entire country. Consider an economy in trouble. Businesses are failing, machines sit idle, and job losses are stacking up week after week. The central bank's first response is to drop interest rates. They make renting money incredibly cheap. This flowchart illustrates the effect. Because loans are suddenly cheap, a local business takes on debt to fund an expansion, building a second location and hiring workers. Those newly hired workers have fresh paychecks to buy groceries, cars, and home repairs. Their spending becomes someone else's income, creating secondary job growth. To guarantee commercial banks actually have enough capital to lend out at these low rates, the central bank uses a second tool. They expand the money supply by injecting fresh cash directly into the banking system. By flooding the system with cheap, accessible capital, the central bank effectively slams the gas pedal on economic growth. But an engine can run too hot. Eventually, the market is flooded with cash, and consumers want to buy things faster than factories can physically make them. This scale demonstrates the imbalance. When you have too much money chasing too few physical goods, prices rapidly rise. This destructive force is called inflation. To stop it, the central bank makes an aggressive countermove, hiking interest rates to make renting money painfully expensive. This immediately changes the math. A loan for a new warehouse becomes too expensive to justify. Expansion plans are canceled. Hiring freezes entirely. As job growth stalls and borrowing dries up, consumer demand plummets. Retailers can no longer hike prices because buyers are scarce, forcing the skyrocketing costs to stabilize. The central bank intentionally inflicts this financial pain, slowing down the entire economy to starve inflation of the cash it needs to grow. On one side, you have a frozen economy where people lose their livelihoods. On the other side, you have hyperinflation. Hyperinflation is an extreme scenario where prices rise so fast that a nation's currency becomes virtually worthless, destroying life savings in a matter of months. The central bank exists to navigate between these two disastrous cliffs. It is a perpetual, high-stakes balancing act. The goal of monetary policy is to keep the country inside the Goldilocks zone. Monetary policy is the specific set of actions a central bank takes to influence the availability and cost of money. Inside this zone, growth is steady and prices remain stable. These macroeconomic decisions dictate your daily reality. They determine why your credit card minimum payment went up last month and why a carton of eggs costs what it does today. When you see a news report about the central bank changing interest rates, you are watching the architects of the economy actively adjusting the rental price of money to keep society balanced.
Share, like, comment, and subscribe.